This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars, episode 103, was recorded on April 27th, 2020. I'm Eric Townsend. This episode of Macro Voices All-Stars is brought to you by TopTradersUnplugged.com, the leading podcast when it comes to quant and rules-based investing. I'll tell you how to claim a free copy of their new guide to the best investing books ever written at the end of this episode. Joining me today is Alhambra Investments Head of Global Research, Jeffrey Snider. Jeff, before we dive into today's interview, I'm going to break the news to our listeners. For anybody who doesn't know, Jeff and our good friend Emil Kalinowski have recently launched their own, I don't know if you call it a video podcast or what. Jeff, tell our audience about what you guys are up to and where they can follow it, because we've got a lot of Jeff Snider junkies who want more frequent doses of Eurodollar input than they're getting just from Macro Voices.
Well, Eric, Emil and I were kind of waiting. We're hoping we could be able to wait to launch a more, a finished product, but events have overtaken us. So we've started experimenting with a video podcast where we talk about current events and current topics. And the idea is to build upon that podcast to get into more in-depth and detail behind some of the shadow money, Eurodollar stuff that you and I have been talking about for years, and really to build upon some of the concepts that you and I have put together for a very long time. So right now they can find us. The podcast is called Making Sense. And I know there's quite a few other podcasts out there called Making Sense, but it's Eurodollar University's Making Sense. Right now we have it up on Alhambra Investments YouTube channel, as well as on my website at our blog at alhambrapartners.com. And we'll be expanding the list as time goes on, as we get better about our own performance and the style and putting the thing together.
And of course, Macro Voices is not video, but instead we've got a slide deck. Jeff, once again, has put together one of his famous slide decks. I love your graphs and charts, Jeff. Listeners, you're not going to want to miss this one. So be sure to download the PDF file with the chart deck, because we're going to be referring to it throughout this interview. You can find the download in the description of today's podcast on our homepage at macrovoices.com, right next to Jeff's picture. Jeff, while the global economy is in free fall thanks to the coronavirus crisis, central banks around the world are trying to save the day. Personally, I kind of think that the cure might be worse than the disease. They're printing money hand over fist to make sure that markets don't price anything other than a quick turnaround. The Federal Reserve is right at the forefront of it, too. Jay Powell seems to be doing just about everything these days, from the usual QE to the more novel approach, he says, of supporting credit markets, in other words, violating the Federal Reserve Act and bailing out junk bonds. The very obvious goal for monetary policy seems to be, hey, just keep the V-shaped recovery, make it happen no matter what, or at least promoting the idea somehow of a V-shaped recovery and keeping that on track. Don't you dare fight the Fed, because the printing press is now running 24/7. What do we make of all this, Jeff?
It certainly seems that way. And these policies are definitely designed to make you think only in that way. I mean, I just look at the Fed's balance sheet. That's a good place to start, especially the level of bank reserves. So if we start on slide 3, this is where the presumed monetary influence comes from. And since early March, it's an unbelievable level of expansion. Over the last 8 weeks alone, the level of bank reserves, just bank reserves, has exploded by just about $1.5 trillion in 8 weeks. Now, that pace is almost triple what Ben Bernanke's shocking effort had achieved in the autumn of 2008. But here's the thing. If we go to slide 4, Bernanke's program didn't work, at all. That $600 billion increase in the level of bank reserves came as a response to a global financial crisis that he couldn't stop. So, despite what we were constantly told was money printing, there would be another 4 months of global financial crisis 1 and another devastating wave of liquidations and fire sales early in 2009 that, no amount of bank reserves would have solved. So the question is, will a much bigger amount of the same kind of thing work this time around? That's really all that has changed. Not the type, just the amount. In every meaningful way, Jay Powell is conducting the exact same type of interventions as Ben Bernanke already had, and they didn't work. And it all comes back to what the modern financial system actually uses for money. This is the same type of intervention as in 2008, and that recent history definitively shows we should be cautious about before pinning our hope for recovery on this so-called record monetary stimulus.
But Jeff, by definition, bank reserves are base money. Anybody can go to the St. Louis Fed's Fred database right now and look up the monetary base statistics, and they'll find bank reserves and be able to track it closely. So where is the disconnect between more bank reserves and actual money printing?
Well, by very old definitions, that's true, Eric. I mean, what you have to understand is how those concepts have been obsolete for half a century already, 5 decades and actually longer than that. It wasn't until the late 60s and early 70s, as you can go to slide 5, that the Federal Reserve realized the quote-unquote monetary definitions didn't work anymore. The Fed stopped using these things a long time ago, not because it wanted to be able to print as much money as it could, rather because officials realized ages ago they couldn't print money even if they tried. The banking system had evolved into using other kinds of transactions, often very exotic kinds of transactions. The Fed could no more measure money than it could try to print any. Therefore, way back in the 70s, these common definitions of money were already outdated, having been superseded by what today look like primitive wholesale techniques. But the Fed has every reason to hide this fact, to keep you thinking that it can intervene monetarily if it ever wanted to. Don't fight the Fed isn't monetary reality. It's an expectations-based policy.
Okay, Jeff, if you're saying those definitions are dated, what's an accurate definition? How should we think about bank reserves in practice in today's system?
Well, let's go slide 6. They're nothing more than a byproduct of the Fed's attempts to intervene. The central bank undertakes some kind of transaction, buying assets or issuing overseas dollar swaps, whatever. And the net result is an increase in assets, which ends up as a remainder on the other side of its balance sheet, what we call bank reserves. Again, even those inside the Fed know this, as I'm showing you here on this slide. The level of bank reserves doesn't tell us all that much, especially about if or how these interventions might be working. If the level of bank reserves is rising and rising quickly, the only thing that tells you is the Fed must be busy. Busy doing what? There's not enough information in bank reserves, but we know it's not money printing. The level of M1 can rise, but that didn't mean much in 1974, and it means even less today. So instead, when we look at these times when the balance sheet of the Fed's bank reserves is accelerating the fastest, like March 2020, like autumn 2008, these aren't good periods in financial history. In other words, if all bank reserves tell us is that the Fed is busy, and we obviously know when the Fed is busy and these are crisis periods, then that's all bank reserves are good for. They act as a warning as to how bad conditions must be in the monetary places that actually do matter as far as effective money is concerned. The shadow system. Go to slide 7. The more Jay Powell feels he has to intervene, the more the balance sheet is expanded and bank reserves are created as a byproduct of that expansion, the more must be missing in the monetary shadows. There must be a huge monetary deficit in the Eurodollar system, and that's where both of these global financial crises have come from. That's effectively how our listeners should think about this. These record reserves imply record monetary deficit, not record monetary stimulus.
Okay, so the Fed is not necessarily going crazy printing money in the most literal sense of printing money, but rather they're going crazy trying to respond to something big and bad going on in the obscure parts of the financial system. The more the Fed does, the bigger the hidden problem has to be. So how does this read line up with what you're seeing in markets? What are the markets telling you about how big the problem really is?
If the U.S. Central Bank, the Federal Reserve, has printed $1.5 trillion in base money in 8 weeks, then why are inflation expectations continuing to cling to crisis low? If you go to slide 8, and I'm not talking about just short-run inflation expectations either. I'm talking about longer-term measures like the 5-year forward rate. These are all the way down at levels more like 2008 than anything you would associate with massive money printing. If you go to slide 9, you can see that history. The bond market knows what the Fed is actually up to, the huge difference between effective money printing and bank reserves. This second global financial crisis is what matters, and that explains the Fed's big response to it. There's a massive liquidity hole that has been opened up out there in the shadows, but because it's in the shadows and you don't see it, Jay Powell is trying to take advantage by making everyone think he's printing money that you can see because it's on the Fed's balance sheet. Yet we know that the massive liquidity problem is there because of what it did in markets during March. And while markets right now in April, they're not like they were in March, we can still observe some of these indirect effects lingering on.
Okay, Jeff, I would assume it's not just tips and inflation expectations where you'd be able to see those indirect effects. So what other market prices or signals contradict the idea of massive money printing?
Well, Eric, how about just LIBOR? Slide 10. LIBOR goes straight to the heart of the modern monetary system in an old school sort of way. I mean, this is the Eurodollar rate, baby. Eurodollar deposits don't mean as much as they did in the 70s and 80s, but LIBOR is still a key rate that is constructed by the very banks who do make up the monetary shadows. Therefore, LIBOR tells us what those banks are thinking about in terms of Eurodollar and broader liquidity risks. Not credit risk necessarily, but systemic liquidity risk, which, as we saw in 2008, became paramount at times like these. So, the LIBOR spread over other associated money rates, it peaked back in March of 2020, which some people are saying is due to Jay Powell's huge monetary campaign. But if that's true, then why is LIBOR still especially elevated, still about 90 basis points? So $1.5 trillion in bank reserves, that's all we got, is a 50-point reduction in LIBOR. This doesn't sound like all that much, but when you look at where other money rates are, like federal funds and repo rates, which are closer to zero for other reasons, the spread of LIBOR above them, including above the 3-month Treasury bill rate, is actually enormous. It's still huge, despite all that huge increase in bank reserves.
Okay, Jeff, so that's the so-called TED spread, the Treasury Eurodollar spread, the difference between 3-month LIBOR and the yield on the 3-month Treasury bill. Anyone who lived through the 2008 global financial crisis probably remembers the TED spread because even the financial Flintstones on CNBC and Bloomberg were talking about it seems like every day on the cable channels.
Yeah, it's one of the key measures of pressure in the offshore shadow money world, this Eurodollar system. So if you go to slide 11, again, despite $1.5 trillion in additional bank reserves, the TED spread is right now higher than at any point it was over the last decade. Other than earlier this month, you'd have to go all the way back to the first global financial crisis in 2008, 2009 before you find a similar level of spread. Now think about what that says. $1.5 trillion in so-called money printing and indications for interbank wholesale liquidity stress remain at levels comparable only to the first GFC. If you go to slide 12, not only that, you can't take anything away from the decline in TED over the last few weeks either. That's not unusual for these crisis periods. Many people are rushing to really, pat Jay Powell on the back for at least, they think, getting LIBOR and TED to come back down. If you go to slide 13, they're making the same big mistakes that they made a dozen years ago. TED doesn't just go up and up and up, and that's not what defines a panic. It goes up and then it comes back down like we see now. Only in 2007 and 2008, it never normalized no matter what Ben Bernanke's Fed did during the crisis. It stayed elevated the whole time, just like it's staying elevated now. But like Jay Powell's Fed, they made a big deal out of every time TED or LIBOR would come down, only to see it pop right back up just a little bit later. Officials didn't really understand the situation they were in. These were only brief periods when they thought they were being successful in soothing markets, when in fact the situation that was hidden in the Eurodollar shadows was becoming increasingly fragile and increasingly dangerous the whole time. So, Ben Bernanke's Fed wasn't supplying liquidity, let alone anything like effective money. That was what the TED spread and LIBOR were demonstrating that back then, growing systemic fragility. It just doesn't happen all at once. Nothing ever goes in a straight line, not even a financial crisis.
Well, you're talking about ebbs and flows, even in the stock market. Nothing's ever in a straight line. There are often big rallies during an otherwise devastating bear market regime because there are times when it kind of looks like the Fed is making headway. And I would argue right now is one of those times. We've got, either a bear market rally is what I think, or probably a lot of people are looking at saying, hey, we're headed back to new all-time highs. It can seem as if things are getting better, and I think a lot of people are thinking that right now, or at least there appears to be a good chance of missing any more serious bad stuff. Of course, sometimes the bad stuff happens anyway.
Yeah, and it doesn't help when the central bank officials are making those same mistakes, and often for the same reasons. If you go to slide 14, for example, in June of 2008, June of 2008, Policymakers really believed they had achieved a huge success. They really believed that they had fortified what was a weakened system by instituting all sorts of these new programs, all those abbreviated alphabet soup of ideas. Paraphrasing what I'm showing you here on the slide, what St. Louis Fed President James Bullard said at the time, he really believed if liquidity trouble returned in the fall of 2008, the system was ready to handle it. And it was a huge mistake. Slide 15. The system wasn't ready at all. Rather, it crumbled because the Fed hadn't actually done anything. It was an incredibly frail situation. And these central bankers just don't know their jobs. They have some theories and ideas, and they've relied heavily on the myth of the Greenspan put. But when push came to shove, they had no clue about how to deal with a shadow money disaster. Instead, they did a bunch of things. The financial media filled up with stories about how impressive those things were. But over here in reality, it was all nothing more than a puppet show. It was the central bank trying to get you to believe that it was all doing this powerful stuff so that you wouldn't sell your stocks, or the banker who might believe in the magic wouldn't fire sale his prime mortgage bond collateral that the repo market was at that time rejecting. It's all about belief. And what is the Fed doing right now? The same damn things. These very same programs that failed time and again during the first global financial crisis, Jay Powell has dusted them off and thrown them out there for a second time. And the financial media is handing him congratulations that the shadow money system never will. That's TED. That's the bond curves. That's inflation expectations, all these things. They're very impressed over at CNBC, but the shadow money system continues to be fragile and frail. Those $1.5 trillion in bank reserves are nothing more than impressive numbers for a puppet show. They aren't real money and they aren't real liquidity.
Jeff, let's talk about one aspect of the Fed's toolkit that is different. Unlike 2008, Jay Powell is explicitly pledging to support markets. Remember they used to, when Jay Powell took office, their first official statement was, we're not in the business of supporting markets. Well, I guess that changed. Bernanke didn't make that promise, where in 2020, the Fed is buying up corporate bond ETFs, violating, as far as I'm concerned, the clear intent of the Federal Reserve Act and using the lamest of excuses with this special purpose vehicle that supposedly turns private credit into government credit. So all of a sudden, junk corporate credit, is hopefully saved from melting down again, or more accurately, if it does melt down, it takes the taxpayers with it. That would be like Ben Bernanke having directly bought subprime mortgage ETFs. That seems to be a really big change. And I think the notion that there's this liberal interpretation of the law. Well, yeah, it's supposedly we're not supposed to buy anything other than government agency bonds, but we could take junk bonds and we could sell them to the Treasury first and call them government agency bonds because we got them from the Treasury. It seems like they're really going to some pretty crazy lengths to reinterpret the law and the rules. These seem to me like acts of desperation, Jeff. Is there something more going on that's making them desperate? Or is there really something different this time? What's behind all this?
Well, Eric, I think you're right. There's more than a tinge of desperation here. And you're absolutely right. They're going way beyond their mandate and stretching and torturing the statutes to accomplish it, which is something that's deeply within the Fed's history, going back to its original institution. But if we look at it in terms of actual monetary practice, pledging to support markets and actually supporting them, no matter how they actually, how they are pledging to do it, these are two very, very different things. That way, buying these ETFs is no different at all. It's all really the same puppet show. If you go to slide 16, the Bank of Japan recently provided us with yet another real-world case study along these lines. Haruhiko Kuroda's central bank has been, quote unquote, supporting the stock market with ETF purchases for a very long time already, including recently. Yet look at what happened to the Nikkei during February, March. As stocks tanked worldwide, Japanese stocks did too. It didn't matter that the Bank of Japan was buying ETFs and J-REITs and explicitly claiming that it would support the market. The major index suffered a 30% decline even with that support. Now, some people will say it was the stepped up purchases that you can see on the chart, which ended the Japanese stock rout. But even if that was the case, and it wasn't, what good did they do? If a market goes crazy and drops 30% before the central bank finds the quote unquote right amount of its activity to finally support it, that's not anything like an effective backstop. because it's not an actual backstop. You have to understand how central banks work and how different they work from how a market works. The Bank of Japan way in advance prepares a list of specific ETFs it will purchase and by how much. The central bank is not responding to market conditions on any given day. It is not fielding calls from panicky investors while taking and immediately filling their sell orders. That's not what happens at all, but you're given the impression that is exactly what happens. All the central bank does is buy up some securities using a predetermined formula, hoping that through a compliant financial media, this will all be misinterpreted as some massive market support, that you and everyone else will make this mistake, that this is the myth of the Greenspan put. So not only do officials hope that you think twice before selling because of this myth, they expect that you'll think about buying, if for no other reason than to quote unquote front run the central bank, even though in reality, the central bank isn't actually buying all that much either. But here's the truth. When another avalanche of sell orders hit the market, the central bank is still going to be buying according to its predetermined list. They aren't taking all the orders as the dynamic market needs. At best, there will have to be some, like in Japan, some board meetings and committee votes to change what goes on to the central bank buying list, or by how much each of the specific ETFs they're going to buy. It's not market support. It is, again, the appearance of market support. It's expectations-based policy, the same stupid puppet show. So the Fed's corporate bond ETF purchases are already according to the same way. The Greenspan put, as you'll see on slide 17, is an empty bowl. And as I've been saying, there is no money in monetary policy. It's purposely designed because central banks can't define modern money to make people think there is. If you believe in the fairy tale, then it becomes a self-fulfilling prophecy. That's exactly what they're counting on. If you believe the Bank of Japan or the Federal Reserve is supporting whatever market, then they expect that you'll think twice before selling, and you may even be coaxed into thinking there's less risk and end up buying more. You do the work of the central bank for it. And it doesn't work. When the global system needs an effective monetary response like 2008 or March 2020, what good is a puppet show? What you end up with in that situation is an underlying fragile state. Here we are after $1.5 trillion of bank reserves, and the stock, like you pointed out, Eric, the stock market is rallying a bit, but even stocks remain significantly well below their highs, while at the same time, these other fixed income markets, they're not buying the Fed's myth one bit.
I want to remind our listeners before we close that you can find Jeff and Emil Kalinowski's new video podcast just by going to YouTube and putting in Alhambra, Alhambra, and you'll find the Alhambra YouTube channel. We've also got a lot of terrific content on Macro Voices this week. We already published my interview with Jim Bianco, and boy, if you are in oil markets at all, you really don't want to miss this one. We think that the worst maybe is yet to come for the oil market. I know it's been pretty darn rough, but it still could get a lot worse. So that was published on Monday. Of course, we've got Jeff today, and we've also got Dr. Lacey Hunt coming up as our featured interview on Thursday night's podcast. This episode of Macro Voices All-Stars was made possible by TopTradersUnplugged.com, the leading podcast on quant and rules-based investing. Be sure to claim your free copy of their recently updated guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. And if you haven't heard it yet, be sure to check out my full-length interview with Niels Kastrup-Larsen on trend-following strategies, which is linked in your Research Roundup email. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.